This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
I want to talk about the Walt Disney Company, a company and a stock near and dear to my heart. I've covered the stock for over 30 years. It is at a place in time that they've never found themselves in. They're really trying to figure out, they and all the media industry trying to figure out how they manage this pivot to streaming and away from the traditional media distribution bundle that was so lucrative. And then I got some changes at the top here. Chris Palmeri joins us. He's the entertainment editor for Bloomberg News. He joins us on Zoom from our LA bureau, and it is a awesome office out there. Yeah, the last one they had was not great, I have to tell you. But this one is smoking. It's in...
What's so great about it?
Oh, it's in a great part of town, Century City, right, Chris? And you got smoking offices.
Yep.
I think you overlook the Bel Air Country Club or something.
Correct.
Yeah, it's just cool. So
a Los Angeles Country Club.
Los Angeles Country, major upgrade. So when I went out there the first time, I kind of talked to somebody back here in New York. I said, we need to upgrade our friends out in L.A.
Yeah.
And then they did. And it
sounds like a missed opportunity that I did not get there when I was there for 48 hours last week.
Chris,
Bummer.
talk to us about Walt Disney here. They're getting themselves a new CFO. What do we know?
Very experienced executive, 3 decades at Pepsi, where he's done a lot of businesses, run their e-commerce business, ran the Quaker Oats business in North America. He's obviously been the CFO since 2010, done mergers and acquisitions, been the face of the company to the finance community, is known for being sort of conservative guidance and over-delivering on the financial targets. So just a real experienced hand at a time of great turmoil, as you mentioned, at Disney.
Yeah, I'd love for you to tell us a little bit more about that. And this is Hugh Johnston, who we were talking about. If you didn't get his name, that's who the CFO is at Pepsi right now, who's coming into Disney. So, Chris, tell us a little bit about the board right now at Disney at the C-suite level. That we have the CFO who vacated due to medical absence, I believe it was. And what's going on with Bob Iger? How much longer is he going to stick around at the top?
Well, of course, brought back now 1 year ago after the tumultuous reign of Bob Chapek, and Bob Iger, known historically as a steady hand, has had his own shaky first year back. There's really so many things in the air, and I think that's one of the things that he'll have to address on Wednesday when they do the earnings call. We've reported they're potentially selling their India media business. They've announced they're going to buy back the one third of Hulu that Comcast owns, so a potentially $10 billion deal. Iger's talked about selling their traditional TV channels like ABC. He's looking for a strategic partner at ESPN. There's so much going on outside of the normal course of business there. So, they obviously need somebody who can talk to the financial community and help raise money and all that.
Hey, so Chris, you've covered the Walt Disney Company probably as long as I have. You're right out there in LA. You're in right where the entertainment industry really lives here. Talk to us about kind of where are they on the actor strike? That seems like something that should be a quick fix relative to everything else that this industry is facing.
It certainly seems like we're very close on settling the actor strike, but we've been hearing that for a couple of weeks now. Bob Iger's been personally involved in both with the actors and the writers. He's one of the quote big four studio executives that's been in the room, or at least on Zoom, during these negotiations. It seems like the actors are going to get a pretty good deal. Not everything they wanted, but sizable increases in pay. And so we're all just sort of awaiting when that news comes, and if there can now sort of pivot to salvage the TV season, which was supposed to start in September and now is earliest maybe in February.
So tell us then, Chris, given all of these things that you just mentioned, we've got the actors strike, we've got the new CFO coming in, there's also, the potential sales of certain units or buying back some other ones. How's the analyst community sizing up Disney's earnings? You said we've got that coming on Wednesday, I believe.
Surprisingly, given all we talked about, I think it's actually supposed to be a good report.
That is surprising.
There's been a lot of cost cutting at Disney this year. Remember, 7,000 layoffs. All of these media companies have been surprising, both because of cost cutting and the fact that there's no production going on. They're saving a lot of money on those TV shows and movies they would otherwise be spending money on. And of course, everyone will be looking at the streaming business and how big the losses are, if making any progress in reducing that. Disney had said they're going to break even by next year in that business, which has just lost billions of dollars over the recent years.
Yeah, Chris, I mean, again, you're right out there in LA. You go to all the cocktail parties with the power players. They've got to be really scared. I mean, because they just don't know how their business is going to evolve. It was such a good business where everybody made money. The cable companies made money, the programmers made money, the advertisers made money. Now this streaming model has really upended all the economics that a whole couple of generations of people have kind of grown accustomed to out there. What's the feeling out there in terms of angst?
It is anxious. It's funny you mentioned cocktail parties. I went to an event, the LA County Museum on Saturday night, and Bob Iger's wife Willa Bay is on the board, and we kind of expected it's literally right next door to the SAG, the Screen Actors Guild building, too, to put it all in context. We just assumed he's been there. He was going to be there. He's been there in the past. Did not show up. So whether I shouldn't read anything into that, but definitely everyone was talking about the strike. It's a big deal, and everybody just really wanting to return to work. There are shows that are just waiting to get restarted, and we're seeing it in what we watch too. I mean, there's reruns that are now the hottest shows on Netflix. Movies are getting postponed in some cases by years. So it's really, you're beginning to see the impact.
Chris, I wanted to come back to Hugh Johnston here for a minute, the incoming CFO, longtime executive at Pepsi. My first thought, and maybe this is a bit elementary, but maybe if I'm thinking it, someone else is too. This is a guy who's working at a company who's famous for soda and snack food and, more like consumer discretionary goods of that nature. Like, what does or consumer staples rather. But I mean, how does that then work for him coming into a company that is so vastly different than that, obviously still in the consumer space, but on the media side of the business? And if he could be potentially a CEO candidate down the line, does he really have the background that Disney might be looking for?
It's an issue. I'm old enough to remember John Scully coming from Pepsi to Apple, and it was not a great run he had there. There's some interesting echoes here. At Pepsi, they also faced a sort of proxy fight with Nelson Peltz, the activist who's now also active in trying to get board seats at Disney, so that may come in handy. If you do some research, you'll find that when Hugh Johnston joined the Twitter board a few years ago, there was a lot of commotion because it was the first time he actually signed up for a Twitter account. So yeah, does he have the media experience to lead one of the largest media companies in the world? No, it doesn't seem that way. But as we were talking about earlier, he is a very seasoned corporate executive with a lot of experience in consumer products.
All right, Chris, thanks so much for taking the time. Appreciate it. As always, Chris Palmeri, he's the entertainment editor for Bloomberg News, joining us on Zoom from our LA bureau in Century City. Again, a great office there. But again, Disney, it's going to be really interesting for their earnings because they have so many questions, as Chris was just talking about, so many challenges ahead of them, as do most media companies. And investors are just like, I can't really own your stock in size until I get a better sense of where your industry is going.
I mean, you've got a feel for this, Paul. Like you said, you covered it for more than years than maybe you'd want to say aloud. But
I'm glad that I'm not covering it or having to come up because I just don't see it. I don't see a clear path for this industry, at least not right now. So we'll have to see how it plays out.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
All right. Who is that band? I know that band. Steve Miller Band. Thank you very much. Great band from back in the day. All right. Who releases earnings on a Saturday? You know who releases earnings on a Saturday?
It's killer.
Somebody who can.
Yeah.
And that's Warren Buffett.
He can.
I mean, and so he does it, and all these insurance people, Warren Buffett followers, they set it up their day to follow it. And one of those people is Matt Palazola. He covers all the insurance stuff for Bloomberg Intelligence. He joins us live here in our Bloomberg Interactive Broker Studio. We appreciate that. He got the memo about 4 days a week. What did we learn from Berkshire Hathaway from the earnings announcement, maybe kind of what we heard from Mr. Buffett?
Yeah. So headline, big gap loss.
Okay.
That is because that's accounting convention. They run the changes in their equity portfolio through the income statement. So Apple had a bad quarter, so you see this top line number come through. I think it was like $12 billion. Do
I look at the A or the B stock? What should I look at?
Either or. They move in tandem.
Okay.
So headline loss there, but the operating company earnings up like 60%. And that was mostly on the insurance segment. So the insurance segment rebounded, had a bad quarter in the year ago because of Hurricane Ian. This quarter you saw reinsurance, underwriting booming, interest income booming. You guys were just talking about the consumer. Their consumer businesses actually did a little bit better. I'm an insurance guy, so it's not exactly my forte. The top line was down like 20% for that business in the second quarter. So I expected it to be down again, but it actually wasn't. So that was kind of a positive surprise, but maybe it might not look so good going into the fourth quarter.
And just tell us, Matt, because Berkshire is such a massive conglomerate of God knows how many businesses. What exactly is the consumer business?
So they manufacture consumer products. I don't have them all in my head. And then they sell consumer products, the retail and sales. So, interestingly, they just acquired with the Allegheny business was Jazzwares, which is a toy maker.
I know the Allegheny company very well.
When I told my kids that this company makes Squishmallows, they were over the moon, like it was the best thing ever. So perhaps that'll bode well going into the holiday season.
All right, cash. They got $157 billion in cash. What are they going to buy? I mean, we've been asking this question for a long time.
A while.
But now the interest rates are up. I'm sure shareholders are not as concerned.
That's exactly right, Paul. So, they have a problem I wish I had, is they generate more money they can actually spend.
It's a good problem to have.
Yeah, my wife might test it out on Amazon Prime if we did. But they're just generating more money than they know what to do with. The great thing is the rise in interest rates, especially in the short end, has helped them a ton. They were earning about $50 million a year in interest income. Now they're earning over $5 billion.
Wow!
Just on interest on their cash.
So that's a model.
That's great. I mean,
why is the stock not ripping on rates then?
It doesn't last forever. I think it was honestly a little bit of a surprise to me that they benefited that much from it. I guess we could have seen it. Maybe people were expecting them to do something with that cash, but they keep it liquid, and that's been okay. It won't be if we start going the other way, obviously.
Yep.
Have there been whispers of what Berkshire could possibly buy? Like what deals might be out there? I mean, like we just said, this is a massive company, so many businesses they're already involved in. Like what more do they possibly need?
So my big thing is I really thought they were going to buy Occidental. It seemed out of their playbook the way they were approaching it, taking kind of little snips. Buffett was very positive on the management publicly, which is things he'd done before. Then at the annual meeting, they came out and said, we have no interest in owning this entire company. Then Chevron became one of their biggest holdings. And I thought, okay, so they're big energy players. Maybe it's an energy business. They've paired their holdings in Chevron. I don't know. I think it's going to be something we never heard of that they end up buying.
Did they buy non-U.S. companies in size?
They haven't. Buffett made some investments in the Japanese trading houses, and that was... I forget the exact number, but it was in the billions of dollars. Right. They didn't acquire them. They just bought the stocks of them. And they have some businesses with foreign operations, but they usually stick to the U.S.
What Tim Craighead of Bloomberg Intelligence explained to me years ago about the European stock index, it doesn't have a lot of tech. Okay? What they have is they make stuff over there in Europe, German, like Siemens, and they make big stuff, equipment and everything. That seems like a play for a Warren Buffett. Go buy a big machine company or something.
I wouldn't be surprised. I mean, one of their biggest companies is Precision Cast Parts, which makes precision parts for airplanes, right? And it's just not something you know that much about or hear about. That actually did pretty well in the quarter too. But it's got a monopoly on these kind of unique parts that no one else can make. And I think those are the companies that they look for.
So if I'm a stockholder right now in Berkshire, do I want to see the company buying back stock or giving me a bigger dividend? Like, what do you think when you see all this cash?
I think the market would love a dividend. I don't think they're going to do that as long as Warren Buffett's around.
And just go back. That's a great question. Why don't they do a dividend?
I think Buffett likes getting dividends. He doesn't like paying dividends. I think he always assumes he can do something better with the cash.
Okay, but that's now been proven beyond a doubt that he can't, because there's $157 billion in cash. Do they buy back stock?
So they buy back stock. Historically, they were not big repurchasers either. What happened in COVID? The stock dipped, and they really started buying in mass. They were buying like $6 billion a quarter at one point. There's some limitations with the A and B shares. They can only be so much of the volume, but the share repurchase has gone down. It was like $1 billion for the past 2 quarters, which obviously is a lot of money, but not for them. Yeah. And it was honestly disappointing. I would have loved to see them buy back more.
All right, let's have a broader insurance conversation.
Shall we?
Who doesn't want to do that?
Please
Everyone
do.
does.
What are the big drivers? A, how are insurance stocks doing these days? And B, what's the driving thing that you guys need to get smart on as analysts and investors?
So, I mean, interest rates are a big thing. So I cover the P&C names specifically.
Okay.
The life names are very much interest rate plays and move a lot with interest rates. The P&C ones...
Property and casualty.
As we say in the biz.
Yeah.
They were in a play on inflation, so the cost of repairing things went up, so that increased their loss costs.
Okay.
But their prices have been going up as well. That's really on the commercial side. It's hurting the personal side as well. The thing is, these stocks haven't done that well this year. They did their defensive plays. The beginning of the year, they all took a dive on the regional banking disaster, which for no reason. There was absolutely no reason they should have felt in sympathy with them. We talked about it at the time. So they spent all year recovering from that. Just to bring it to Berkshire a little bit, Berkshire's outperformed all of them. So they haven't really moved like an insurance company this year. But so you want to get smart on insurance companies. It's rates, it's loss costs. We just came out of the third quarter. Things were actually better than I expected, and the stocks underperformed. I think they have maybe another year of peak ROEs. The valuations can peak before the ROEs, so there actually is probably room in those stocks.
And we haven't had any big hurricanes and stuff.
That was going to be my
this
question
year?
next. Yeah, because you mentioned the Ian impact.
I'm going to knock on wood here.
So we had a bunch of weird stuff happen in the quarter, right? We had the Maui wildfires. We had we had the tropical storm hitting California, and these were they were odd events.
Right.
The Maui fires were very bad in the humanitarian aspect, and the insured losses were small for the industry. We haven't had a big event. We haven't had like a Hurricane Ian this year, and it's allowed these companies to build capital. But things have been worrisome. Even this, there was a big hurricane in Mexico. Otis. And I looked at it, and my just kind of very initial blush was, okay, it's not going to be big for the reinsurance community. It might be big for the domestic market. It's coming out maybe at $6 billion, which is a modest industry loss. Again, it's probably going to hit a lot of the Mexican companies. But if you look at the damage there, it was some of the strongest winds literally ever recorded. So we're kind of on the precipice of maybe something big happening.
All right. Matt Palazola, thanks so much. We appreciate it. Property and Casualty Insurance Senior Analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio here, talking about the insurance business. Warren Buffett, $157 billion of cash on the balance sheet. What is he to do with that? That's kind of the big question that investors have been asking. A little more coming up. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, Molly Smith, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Don't know about you, Molly, but last week felt like peak rates to me. And I know nothing about that, but I just felt like peak rates to me when I saw
Yeah, the Powell pivot. That's
Yep.
what we're talking about.
I don't know. We'll
It
see.
could be the end.
Let's talk to somebody who actually gets paid to do this. Liz Young, head of investment strategy at SoFi. She joins us on Zoom from New York City. Hey, Liz, what did you think of last week's action in the markets? Again, just to me, it kind of felt like peak rates, both in the bond market, and I looked at how the stocks were moving. And how did you view it?
Well, first of all, it's difficult to call a peak really in anything, so I won't do that because it's a real easy way to
smart.
be wrong.
But I do it for a living. So.
It certainly does feel like we went down very quickly, and it would be difficult to pop all the way back up that quickly. So last week's action I would take, obviously it was a strong week in the markets. Last week's action I would take as a bit more of a relief rally. I know now we're in this debate of whether or not it's a bear market rally or new durable upside, but I would take it as a relief rally. And I think the market interpreted what Powell has said and what went on in the jobs market on Friday as an indication that the Fed does not have to go any further, and interpreting that so far as reasonably positive. The problem with that interpretation is, as Powell has pointed out, and as I think all of us do know, that there are still some effects that are in the pipeline waiting to come through the rest of the economy and certainly come through the capital markets. So I don't think we're in the clear yet, but I do think that there's been some relief in the market on the expectation that we may actually be done with the hiking cycle.
Not in the clear yet, Liz, as in there still may be another hike. Is that what you're suggesting?
Not necessarily. I mean, so first of all, I don't think the Fed is going to declare the end of the hiking cycle. They really can't do that, especially with inflation still as far above target as it is. So they're going to leave the door open no matter what until we get closer to that 2% target. And they continue to reiterate that 2% means 2%. And I think that we should listen to them until that changes. And I'm not sure that it will change. So when I say not out of the clear yet, I mean that if you think back through this hiking cycle, we know that it's been fast and furious. We know that it went really, really far. But we even think back and forget that we had 75 basis point hikes. We had 4 of those in a row. And then we had another 150 basis point of hikes after that. I do not think that all of the effects of those have come through the system yet. So that's what I mean by in the clear. I still think that we're going to see some credit tightening. We obviously have this tapering program that continues to go on. And we're waiting to find out if companies are going to be squeezed by borrowing costs as they try to roll over their bonds. So I don't think all of those questions have been answered yet, and getting through, earnings season that has been maybe a little better than average, but we have a market that's been punishing companies even as they beat earnings. So that's why I say I don't think sentiment is quite all that positive yet.
That's kind of where I wanted to go, Liz, just kind of earnings. As a former equity analyst, I do pay attention to what these management teams say, particularly on their guidance. And while a lot of companies have, I guess, beaten on their quarterly numbers, almost to a company, they seem quite conservative on their outlook. Mm-hmm. And I guess that's prudent given where we are. But what level of concern does that raise for you?
Well, I mean, I think it's good that companies are being prudent. And that's really been what's gone on throughout this earnings season, because some of the numbers have disappointed, but the numbers have not been all that bad. And it's possible that we're going to have the first positive quarter of earnings growth, which would technically take us out of the earnings recession. The issue is that the guidance has been soft, and investors are now in a place where I think the tone has shifted. So for the quarters before this, the bar was really low, and it was easy to jump over that bar, and companies got rewarded for jumping over that bar. Now we're in a place where the bar is higher, and the expectations for fourth quarter earnings and 2024 earnings are pretty lofty, and investors are hoping that companies can prove that those can come true. The guidance has been soft and probably a little disappointing versus what people wanted to hear from CEOs about the following 12 months. So I think it's good that companies are being prudent. I also think that we need to remember, yes, it's good that inflation has come down, but it also means that pricing power likely comes down as well, and that revenue comes down for some of these companies because they cannot pass that all through anymore.
Something I wanted to ask you about, Liz, is looking at financial conditions. Obviously, that's a wide-ranging term of what the Fed looks at in evaluating how effective its policy is. And a story that we did last week going into the Fed meeting was about the tightness of credit spreads. And I wonder if that's something that you've been looking at as well, because to me, when I look at high yield spreads now under 400 basis points, and to think that the Fed has been hiking rates, for the past year and a half, I'm a bit confused here. I mean, I'm hoping you can help explain this one to me.
Unfortunately, I can't. You and me both a little confused by that.
What is going on here?
It feels like it's like watching a pot that you're waiting for it to boil and it's not boiling. I honestly am not sure yet. We've had a pretty big correction in the equity markets since the end of July, and spreads didn't really respond to that. A little bit, but not the way that you would have expected, particularly high yield spreads. So I think so far we've still got a decent amount of companies with attractive borrowing costs because they haven't had to do much with it. But I do think, again, back to those lags and the things that are in the pipeline, I do think as we go forward into 2024, we're going to hear more about that. The other thing that I would say about spreads in general and just credit that's available, if you look at the equity action in small cap stocks, one of the reasons that small caps are getting hit so much harder is because they are generally companies that are still trying to grow and they don't have enough capital to finance their own growth. So they have to go to debt and equity markets. Small caps continue to be under pressure and they can't find durable upside. I think that is a signal that the market is sniffing out small caps are going to be under pressure because of this higher cost of capital. Over time, as that affects companies in the debt market, I do think that you're going to see an increase in spreads.
On the equity side, Liz, what are the sectors that you're looking at these days?
This is going to be really boring, but because I am cautious, I think the sectors, particularly in the equity market, that investors can think about are consumer staples. I do think that utilities is an okay thing to have in the portfolio. I like energy. I like healthcare as, in the large cap space, a defensive play, but also kind of a growthy defensive play that's not quite as connected to interest rate moves as things like technology and communication. So those are the sectors that I would be looking at. I also think that there's still a decent opportunity in treasuries. I mean, yields have come down a lot in the last week or so, but there's still a pretty good opportunity. And these are yields that are higher than I've seen in my career. So, it's not necessarily too late either.
Very good. All right, Liz, thanks so much for taking the time. We really appreciate getting some of your insights. Liz Young, she's head of investment strategy at SoFi, joining us on that Zoom thing from New York City.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.